Assalamualaikum warahmatullahi wabarakatuh. Today we are going to look at sales, collections and accounts receivable cycle. Under this, we will start normally by understanding what are the inherent risks in the revenue and collection cycle. And in this particular topic, we are going to look at how the revenue recognition are being done improperly, and also what are the possible common errors or fraud indicators that we're going to look at. At the same time, in order to understand the cycle, we normally look at the business activities, source documents, and also control procedures that occurred in the cycle. Based on that, normally we will design our test of controls, test of details of balances, analytical procedures, and also test of transactions. Okay, we're talking about inherent risk. Revenue is one of the normally being considered as a high risk areas because there are always actions where the improper recognition are actually being done. So normally in order to look at the revenue recognition, we will actually look at the basis of recognition. Basis of recognition is actually to know at what particular point you are going to recognize your revenue and what document normally being used in order to recognize your revenue. And this policy must be consistent throughout the business practices. Number 2, cutoff. What is cutoff? Cutoff is actually to ensure that the revenue is being recognized in a proper timing or period. For instance, if we are talking about revenue that incurred in the following year, such as if the year end is 31st December, all the revenue that incurred in the following month, which is January, by right should be recognized in the following year and should not be recognized in the present year. Okay, so that's why at the time of the cutoff, 31st December, sales testing will be done to ensure that proper completeness of the sales transactions are being taken up properly. The next one is channel stuffing. Channel stuffing is the business practice where they will try to push the sales or inflate the sale at the end of the year by pushing sales to their channel distribution, such as to their warehouses, to their the next distributors, in order to push the sales at the end of the financial year end. And you can detect this by actually looking at after year end there is sales return, from the distributors. Right. And then the next one is returns and allowances. That's why return and allowances are very important also to look at, particularly after year end, right? Because we want to see there is a proper and authorized returns are being done, and also proper and authorized allowances or discounts are being given to the customer. This is to avoid all the above, cut-off, channel stuffing, and so on. The next one is collectability of receivable. Collectability of receivable is to ensure all the receivable that you sell to your customer are going to be collected. Okay, because by here we also want to know the sales are actually exist. The customer is also exist. That means you are not talking about a bogus sales transactions whereby at the end of the day the sales amount cannot be collected, hence you provide for doubtful debts and later you write off, which is at the end of the day will eaten up your profit. So in order, when we're talking about revenue recognition, we normally make use of the MFRS 15, which is supersede all the rest of the MFRS that has been issued early on. It's covered across the different sector, different industries, and so on. So what are the core principles that being mentioned in the MFRS 15? It's actually mentioned about recognizing revenue, which is to reflect transfer of promised goods or services. So this is what it means by basis of recognition. At what point you want to recognize By right, it should be at a point when you transfer the goods, transfer the services to the customer. Okay, that is the basis point. Secondly, amount that should reflect consideration. So this is the measurement, the value that you should recognize. Okay, so it should be based on consideration which happen at the point of when you exchange for the goods and services. So what is the valuation of your goods and services? Normally, in order to do the revenue recognition, the standards has stipulated the 5 underlying principles. Number 1, identify the contracts with the customer. What is contract? Under the business law, you have made an offer and the customer has made an acceptance. So you bind the contract. And normally in the contract, you mention who are the parties involved, what are the terms agreed with the customer, and what are the specified criteria such as the payment terms, the price, okay, and etc. Secondly, you also mention about performance obligations in the contract. For instance, okay, when you buy, what actually you buy? Okay, what are the delivery of the services, or what kind of services that you're going to deliver over the time, because sometimes it will not at one particular point of time, but it covers several times. I give you an example. Okay, when you sell, let's say you go to the grocery shopping. Okay, you take your groceries that you want and you pay, right? So basically, what is the performance obligation that has been agreed by the company is that they are going to sell groceries to you. But another example where you have a bundle kind of product, or you buy in a bundle. For instance, okay, you buy a car. When you buy a car, you go to the car company, such as like Honda. You buy a Honda car, and sometimes it will come together with the 5-year service of the car. That means when you buy the car, for the next 5 years, you are also going to get a warranty on the services, warranty on the parts of the cars. Okay, so this is what it means by bundle. That means when the company sells the car, in the first year you will recognize the value of the car. But for the rest of the 5 years accounting period, you have to recognize the value of the service that you have already warranted to the customer. Okay, so that means there is like several portions in the contract, in the revenue, that you have to split. Which one is to be recognized in the first year, which one to be recognized in the following year. Similar like when you sell handphone, okay, by the telco company to the customer. When you sell handphone, you sell also data line. Handphone will be recognized in the first year. However, data line will be recognized upon when it is already occurred. Okay, so this is what is happening in the current business practices where you bundle it. And then you also have to determine the transaction price, okay, because transaction price depends on the value of the value of the goods or services that you are going to sell. Is it at market value, is it at cost, or is it at net realizable value? Because sometimes you are using scrap value, so it depends. So the fourth one is allocate. So this is what I mean by allocate the bundle products into the respective accounting period where you are supposed to deliver your performance obligations as already being agreed in the contract. Okay, and finally, of course, you need to recognize. So once you already allocate the measure, right? Remember the basis in the financial reporting standards. You have measurement, you have recognition. Alright, so then you will recognize the revenue as once you already satisfied the performance obligations. Okay, so it's actually the basis that you are going to use at what point you want to recognize and what will be the amount to be recognized. Okay, in order to audit sales and collection cycle, most of the time we start with the identifying the significant risk. That means we assess the inherent risk, we assess the risk of material misstatement. for the account receivable, because we want to know which are the angle that we have to do specific audit procedures which we should not skip. Okay, so that's why we need to identify the risk, okay, of the account receivable. And then after that, we should have set already our performance materiality for account receivable, because this will be used as a benchmark when we have exceptions. The next one is that to assess control risk for the sales and collection cycle. Okay, because we know that when the control is good, all the documentation, alright, the information inside the cycle would be more reliable. So in order to know, to test, alright, to rely on the control, normally we design and perform tests of controls and also tests of transactions for the sales and collection cycle. Okay, this is sometimes also we call it walkthrough test or re-performance test. And then the next one is we design our substantive analytical procedures. So this is normally being done in the fieldwork, okay, during the fieldwork, because tests of control normally being done in the interim audit, alright, and then substantive analytical procedures and also substantive testing, meaning test of balances, normally will be done during fieldwork.